euro crisis. Can Greece still be rescued? In the interview, Chief Economist at Berenberg Bank, Holger Schmieding.
Mr. Schmieding, Greece is desperately waiting for the EU and the IMF to hand out new emergency loans, but the country is already sitting on a debt mountain of around 340 billion euros. Isn't Greece already bankrupt?
I don't think that Greece is really bankrupt. Greece has, of course, the problem that it cannot borrow at the moment in capital markets, and it will probably be unable to do so for a year or even two. However, if the Greek economy is reformed, if Greece does what it has to do, that is, promote its growth potential by opening up the labour market, by privatizing state property, then it is possible that, say, 1 or 2 years from now, Greece will be growing again, and that this growth will help the capital markets to regain confidence in Greece. But in the meantime, Greece indeed needs conditional support loans from Europe and the IMF.
But these austerity measures required by the IMF, for example, aren't they too hard for the people who live in Greece? I mean, really, can they sustain this, you know?
The austerity measures are really, really tough. Greece last year cut its budget deficit probably by more than any other Western country has in recent decades. Greece is now even asked to do a bit more. I think that the focus should no longer be on austerity in Greece. They are really, really reeling under that. The focus ought to be on the economic reforms that promote future growth. For instance, opening up further professions in the labour market so that more people can become taxi drivers, truck drivers and the like. Privatizing state property so that from the revenues from privatization, Greece can pay down part of its debt. That ought to be the focus. It is an open question what Greece may or may not have to do to its debt, say a year from now or 2 years from now, but the Greek case is definitely not lost yet.
What could be the consequences if Greece were to go bankrupt? What would happen, from your point of view, to other Eurozone members?
Nobody knows what really would happen if Greece were to stop paying its bonds. But we know from the example of the disorderly default of Lehman Brothers 2.5 years ago that a risk of a chain reaction in financial market does exist. And we know from that example that, say, a buyer's strike, distrust in banks. What would happen to banks if Greece were to default? That distrust in banks, a financial market chain reaction, can cause a very, very serious recession, can lead to millions of job losses outside Greece, can lead to huge fiscal holes outside Greece. So I think we should not make the test whether or not a Greek default could trigger a Lehman-style event. I'd rather not find out. I'd rather continue to contain the risk.
So it's in the interest of all the other Eurozone members that Greece doesn't default. Do I get you right?
It is in the interest of all other Eurozone members that Greece does not default, because the risk does exist that from a Greece default there would be spillovers to other countries, Portugal, Ireland, and then possibly Spain or potentially even Italy. The nature of a panic is that people panic without actually asking for the precise reason. So in a panic, it is possible that, for instance, Spain and Italy, which have comparatively modest fiscal problems relative to those of Greece, at least that is, that these countries would tumble, and if they were to have default problems in a chain reaction, in a market panic, then all of Europe might indeed have a problem which could be as bad or worse as the one we had after the Lehman disaster.
So what about other smaller economies in the Eurozone like Portugal or Ireland? Do you see a risk of them going bust?
They need now official support to pay their bills. But I think for them the fiscal numbers are even very different from those of Greece. Greece has a Herculean task to turn itself around and regain market trust. And it's a very open question whether Greece in the end will succeed. Portugal, with its much lower starting level of public debt, needs much less austerity and has a very, very good chance to turn itself around with growth-promoting reforms. Ireland is a small, open economy with a huge export sector. Ireland has a very good chance to raise its exports over the next year or two to such an extent that it should have no problem, probably already a year from now, to regain confidence of capital markets and to fund itself on markets without further official support.
But how can it be avoided that speculators bet against these countries, which you just mentioned?
I don't think that speculators play any significant role in the Eurozone debt crisis. No. It is the normal conservative investors. It is pension funds. It is insurance companies. It is your normal private investor who, spooked by the events of a year ago, spooked by the near panic which we had in April and May last year, spooked by that, it's these kinds of investors which are simply not buying the government bonds of these countries. It's a buyer's strike. It is not any speculation against these countries that is the problem. And to end these buyer's strike for these three smaller countries and to prevent a buyer's strike for Spain and Italy, we do need measures such as the European Stability Mechanism.
What kind of signs do you want from big economies like Germany? Well, how should Germany react to give confidence towards the markets?
Germany, by and large, is having the right approach. It is saying, A, we do support our European friends in need, and we know that we're actually doing it out of our own interest, because a chain reaction in global financial markets would hit us as an export-independent economy extremely hard. And Germany is insisting on tough conditions for any aid. These conditions, if set appropriately, should make it much easier for these countries to eventually regain market confidence and to grow again, just as Germany a number of years ago was in dire straits. Germany was the sick man of Europe 10 years ago. Germany needed intelligent austerity and labor market reforms to turn its economy around, which it has now done. Just like that, Greece, Portugal, Ireland now need a similar program. They are implementing it and will, with luck, in a few years' time, also be able to follow the German example and grow nicely again.
So we need some patience, to give patience so that these countries can do what they have to do, and then it will work out well, if I understand you correctly.
We need a tough love approach. Tough is tough conditions. Love means, but if somebody meets the tough conditions, we support that country in the meantime. And I do think, yes, we need patience. Greece has a 3-year program, not a 1-year program. We may have to adjust it in the meantime, yes, but we will probably have to support Greece further in its 3-year program before Greece can finally show the results that, with luck, may make it possible for Greece to fund itself again on the market.
Thank you, Mr. Schmieding. Thank you for that interview.
You're welcome.